Today we want to finish up the relative value analysis, look at a few example models, and then real quick on portfolio management. Won't spend a lot of time on that. You can take a whole class in portfolio management at UTSA, which I recommend if you're interested in investing. And then get quickly into the last topic for the semester, which is derivatives. One of my favorite topics, especially options. Here's an example of a relative value model. We've got 79 companies here in different types of consumer staple types of products like agriculture and brewers. And so we bring in several pieces of data. This data is a little old, but it's, you can update these things at any time on the Bloomberg machine. It only takes a few minutes. And you've got data you can do thousands of companies and hundreds of pieces of data and get the data fairly quickly. But we wanted to look at, how fast are their sales growing? What's their asset turnover? Revenue to assets. Is their asset turnover getting better or weaker? How are they doing on capital management, managing their receivables or inventory? Then we look at margins. What do their gross margins look like? How's their net income, their EBITDA doing? How's it growing? The EBITDA margin, is that getting better? Then we start looking at return on capital, like return on assets, which is asset turnover times margin. Economic value added, what is it, and is it expanding? Then we look at some risk factors. What's their probability of default? How much debt do they have? How volatile is the stock? And short ratio, not as critical as a number, but after GameStop especially, the short interest ratio can actually harm you using that as a risk characteristic. Because firms with high short interest ratios, that means there's a lot of people shorting their stock. If you have something like GameStop happen again, you could really get destroyed by that. But unfortunately here you're buying firms with low short interest ratios and you're avoiding firms with high short interest ratios, which means in essence you're avoiding a GameStop just before it goes up to 300, 400, 500%. So it won't necessarily hurt you by having a stock fall a lot. It just means you'll avoid a stock that's going up a bunch. So short interest ratio, not one of my favorites, but we put it in there. And then, so remember we want measurements on fundamental, and that's what all this stuff here is. So on fundamentals, so sales growth, turnover, margins, return on capital. And then we wanted some items on risk. My favorite is the probability of default, and the reason I like that ratio, it's a ratio that Bloomberg provides where they say here's the probability this firm's going to default. So some firms have really high probabilities, like over 2%. Some firms have very low probabilities, like 0.24% for Cisco Corporation, a large corporation. So I like it because anything else we can think of, like debt to equity, volatility of earnings, anything like that, should be covered in this ratio from Bloomberg. So that one ratio covers a lot of things on risk. And so we're going to use those fundamentals and those risk factors to try to associate them with the relative value analysis. So we're going to look at, I have two in here. I have EV, the EBITDA, and I have EV, the sales. Why do I like to use EV to EBITDA? Well, if you use price to earnings, a lot of times you'll have firms with negative earnings, so they don't have a price to earnings. But when you add back interest, taxes, depreciation, amortization, you get a lot fewer companies with negative earnings, so you end up with a lot more EVs to EBITDA. Obviously, EV to sales, that's what you want to use because they're both before interest expense. So we don't want to use price to sales. We want to use EV to sales. And it should work really well for all companies because all companies should have positive sales. So after we do that, then we're going to rank the companies. So you can see Molson Brewing had the #1 sales growth. So if you go back to their sales growth was 53%. Now that could be distorted. So we're using a model to run the numbers. They may have their sales growth high because they purchased another firm. So there could be a reason, but we're going to let the model still go for it. So that firm ranks #1 on sales growth versus Alcoa is one of the weakest on sales growth. That may just be because metal prices were down at the time we did this. Then you look at asset turnover. You can see Cisco Corporation has really good asset turnover. That's revenue to assets. So they're generating a lot of revenue without having to put a lot of property and plant equipment into it. They also rank well on how their asset turnover is improving. On capital management, you can see Alcoa does really well on capital management. Gross margins, as you can see, one of the brewers has a really high gross margin. EBITDA growth, you can see Constellation Brands has really high growth. That could be because they've done quite a few acquisitions, so that could be part of that. You can see the two brewers, Brown-Forman and Constellation, rank really high on EBITDA margin, and Constellation shows really good improvement in the expansion of their margins. Return on assets, Boston Beer Company does really well. As far as EVA, Colgate, Palmolive do really well there, and they've improved dramatically, whereas Clorox scores well, but they haven't improved much. So they must be consistently good, but they haven't gotten better. Whereas Colgate is both really good today and they've improved a lot. You look at risk. Now on risk, we have to grade this a little bit differently. So all these other ratios, for most part, not all of them, but most of these other ones, higher was better. The higher number was better, but on probability of default, lower is better. So Procter & Gamble has a very low probability of default. And you look at the debt levels, and there are some firms that have very high debt and some firms that have very low debt. But that should be captured also in that probability of default. Volatility, again, low volatility is ranked first. So Cisco Corporation has the lowest volatility. And then short interest ratios, again, lower is better. So Alcoa is not a very highly shorted stock. Whereas Tootsie Roll, for some reason, was a highly shorted stock back at this time. I don't know why anybody was shorting Tootsie Roll. So we're going to take all that data and we're going to compare it to valuations. So the valuations, number one, means they're the most expensive. So you can see Brown-Forman, they're one of the most expensive firms out there. Constellation, very expensive when you look at EV to sales. And so then what we do is we weight all of these. I have weights in here based on the model, but we usually start with equal weight. But here I'm just, I'm using the model output. And so here's the weights on the fundamentals and risk. So I bet Monster is number one. Let's see if I can find it. Yeah, so Monster is, our model ranks them as the best company. They have really good, they're strong on everything. So if we go back and look, especially where they're strong, really strong on risk, they're very low risk, they're very good on EVA expansion. They're really good on margins, extremely good on growth in sales, growth in earnings. Obviously, they're very strong on growth in sales because everybody's buying these energy drinks now, at least at the time this model was run. So they're number one. They're our number one ranked stock. However, they're the second most expensive stock. So that's not good. That's not what we want. So what are we looking for? Here's a firm that's ranked really high, but they're the most expensive. Well, 8, that's a really high ranking, but they're the most expensive. And Constellation Brand ranked really high, but they're the third most expensive. So relative to how much they cost, not a good stock. So what I like are firms that we think are great that are not that expensive. So Procter & Gamble, actually we bought Procter & Gamble after this analysis. Our model liked them a lot. Ranked number 3, and they were the 10th most expensive. And same thing with Colgate. I don't think we bought Colgate. We did buy Procter & Gamble, but Colgate was on our consideration list, on our potential buy list. They're ranked number 2, but they're only the 13th most expensive. And so you look through there, you're trying to find firms like Hershey's. We did actually buy Hershey's. Our model ranked Hershey's number 4, but they were the 12th most expensive, so there was a disconnect there, so that looked good. It's hard to find obvious ones. This firm here, Lancaster, 17th versus 24th, that may be okay. This one looks pretty bad, right? Estee Lauder, our model only likes it 21st best company, and yet it's the 6th most expensive. Pepsi is a stock we used to own that we actually sold after we ran this model. Why? Because, oh no, actually we bought Pepsi. Excuse me, I said it backwards. We actually bought Pepsi. Our model liked them a lot, and they are one of the cheapest ones out there. So you see how this works. You know, we're trying to find where we rank them high, but the market doesn't have them expensive. And you can actually graph that, and when you graph it, you get our ranking as far as how good we think they are versus how expensive they are. So if you had like a firm that was right here, we would rank it number 1, but it'd be the 80th most expensive. That'd be great, but you don't see any firm up there. Here's Monster. We rank Monster number 1, but they're the 2nd most expensive, so they're on the cheap side, but not that cheap. So these companies right in here were the companies we had on our buy list. We ranked them, so this line here would be the firms that are perfectly ranked. Like right here, this firm, I don't know what firm that is, but we ranked it 16th, and they were the 16th most expensive. These stocks over here we don't like this one right here, we ranked it 46th, but the market had them the 29th most expensive, so we don't want stocks over here. So we're looking for stocks in these categories. So if you want to learn how to build a model like this, and I'd really strongly recommend that you do, the Investment Society shows you how to do it. You can join a sector team in the fall. Hopefully we'll be back up and running with our sector teams. Or the Investment Society, you know, if you go to my YouTube channel, I have a section on Bloomberg models, and you can just teach yourself. Build your own model. I've had some students do that. We actually had a student who was not a finance major. He was an engineering major, and he just wanted to learn about investing, so he joined the Investment Society. He became a senior analyst his first semester. I was really impressed. He asked to set up time with me to learn how to build a model, and I said, yeah, I can do that. And I walk in, and he's already built his model. He did it entirely watching the YouTube videos. Really impressive, and his team ranked one of the highest top 3 teams in the competition. Very, very impressive. So you really can teach yourself how to do this. Once we get back on campus and you have access to Bloomberg, you can do some really impressive things. We presented these models to portfolio managers, chartered financial analysts here in town, high-ranking investment professionals in San Antonio, and they were all very, very impressed with these models. In fact, one guy who managed money at Victory Capital said he was going to take the model back and show it to his team because he felt like his team missed something after seeing the models we presented. So that was really impressive. So this is what a model looks like. There's different ways to do it. This is a ranking model, so you can see we're ranking each stock. You could do a regression model where what you do is you take all of this data here and use all of this data here and regress it against the EV to EBITDA and the EV to sales, and you let, now you can't use 20 things to forecast 2 things. You can take 20 things and forecast 1 thing. So we'd probably use all of these things to try to forecast EV to sales, and let the model tell us the slope. We look at the slope on each one of the factors and make sure that a factor that is higher means better. It should have a positive slope, something like sales growth or gross margin. And a factor where low is better, like the probability of default, make sure it has a negative slope. And that's the frustration with a regression model, is a lot of times the data is just too noisy, and you get the wrong slopes, and you say, well, it gave me the wrong slope on this factor, so I'll just kick that factor out. You run it again, and now another factor has seen its slope go negative. So we tend to prefer factor models, ranking models. Just to us, it's much easier to deal with. It's not quite so cumbersome. But imagine you build something like this yourself and take it, put it on LinkedIn or take it into an interview. And I've had students actually present their models in an interview, and it's very, very impressive. So I strongly strongly encourage you to at least try it once, get some exposures, get some experience, or join a sector team and just learn it week after week after week real slowly how we built this model. Now, we didn't stop here. So at the very, very end, we had our list. Firms like Colgate and Procter & Gamble and Pepsi. We had a list of about, I think, 10 to 15 firms. And then once we had that list of 10 to 15 firms, we then went into each firm and looked at them in more detail. We did very specific company analysis to try to figure out, based on that list of stocks that our model says was really good because we ranked them high but they weren't overly expensive, we then had to go through and just rigorously look at each company individually. So that brings us into portfolio management, because what we were just talking about there is how to do screening of stocks in order to build a portfolio. So what we just did was a perfectly reasonable approach. Whether you'll beat the market or not, that's a pretty big question, but pretty reasonable approach to at least getting to a list of stocks you might be interested in. So let's say you want to start your own stock portfolio. Well, I would recommend that you have at least $100,000. You could build your own portfolio with $25,000, $30,000, $40,000 if you wanted to. If you're just, I recommend once your portfolio gets well below $50,000, you're better off putting your money in a mutual fund and then setting up a paper portfolio at a broker and just doing your stock investing with play money. I would recommend it. It gets tough to set up a really good stock portfolio with less than $50,000, but it can be done. I've done it with some charity money where it wasn't too bad. You can get a decent portfolio of 80 stocks. But generally, I think you probably want to be over $100,000 just so you can get access to stocks that are trading at $1,000. It makes it really tough if you only have $30,000 to invest, and there are stocks out there with stock prices several $100s. Really limits what you can do. You almost have to avoid those stocks because they're just one share of stock is going to be a big part of your portfolio. Now, bonds is a completely different story. Bonds are an institutional market, an over-the-counter market. You really don't want to buy bonds on the internet or through a broker. Individual investors are far better off using bond mutual funds or maybe bank and life insurance product. There's other ways to get access to bonds other than just buying bonds. If you buy bonds individually and you only have $30,000, you will get ripped off quite dramatically. I've just seen story after story of that. And institutional investors, they tell me what they've seen on the individual bond side with retail investors, how the brokers are ripping them off, not 1-2%, but ripping them off 8, 9, 10%. You're essentially starting off 8, 9, 10% behind if you buy individual bonds. I know a lot of individuals buy municipal bonds, and you can buy municipal bonds if you only have a few $100,000, but even then I think you're far better off using a mutual fund because you can get diversified much more quickly. They tend not to be really expensive funds, and what you're paying in management fees will more than offset, more than cover you for what you're going to lose in the trading. You really get crushed when trading bonds as a retail investor. So I'd recommend you need at least $50 million to really have a good bond portfolio. So if you're going to be picking stocks, you're going to build a stock portfolio, then you have two questions, and these are the two questions I like to ask in interviews. Define what is a good company and define what is a good stock. And I just showed you my definition of both. A good company is like Monster. They rank really well on turnover and margin and return on capital and have low probability of default. That to me is a good company. What's a good stock? A good stock is a good company that's not expensive. So we saw Monster was a good company, but not necessarily a good stock because it was ranked number 1 on our model, but it was the second most expensive company. So not so good. But Pepsi was both a good company and a good stock. It ranked well on our model, and it wasn't nearly as expensive as what our ranking showed it to be. So that's my definition. Now, when I ask undergraduate students without experience those two questions, I would get the most horrible answers. It's very, very frustrating. And some of them, I would interview UTSA students who had my class, and I would just be sitting there thinking, how can you give me that answer? It's just almost as if they never had taken a finance class. So somehow in your finance classes, step back and think about, what do you believe? What is this all telling you? What is a good company? What did you learn in 3013 is a good company? What are good fundamentals? What are good ratios? What are the ratios you want to look at? You want to be able to answer that in an interview. What is turnover? What is margin? What is return on capital? What is debt to EBITDA? What do you want it to be? What's times interest earned? What are some good turnover ratios, like revenue per employee, revenue per square feet? Those are the kind of things you want to know so you can define what a good company is. But just because a company is really good doesn't mean the stock is good. If you rank them number 4 out of 400 companies to say, wow, this is a great company, but if they're the most expensive stock in the market, then the fact that you rank them 4th, but they're number 1 in valuation, that's not a good stock. Now, I don't know if I want a stock that I rank as 150th and they're the 300th most expensive. You can say, well, they're 150th, but they're 300, so they're really cheap. They are cheap, but they're not a great company. I like good companies that are inexpensive. Now, you won't find a lot of those. We saw with Pepsi, I forget the numbers, 5th and 13th, something like that. So we rank them 5th, but they're the 13th or 18th most expensive. 18 is still pretty expensive, but it's a big difference between 5th and 18th. So that gives us, we rank it much higher than when the market ranks it. So that's a good stock. I like that. So I prefer to have stocks that are ranked high on my fundamentals, and they're low risk, have good fundamentals, and they're not overly expensive. A good term of that, and we'll just see it here a little bit, might be growth at a reasonable price. There's all kinds of strategies that people play. I tend to do a valuation strategy. Good companies, good high quality companies that are trading not overly expensive. So if you want to build a portfolio, and I strongly recommend you go through this process before you start interviewing for jobs. It's extremely important. You need 4 things if you're going to build an investment portfolio. You need a philosophy, you need a process, you need construction, and you need risk management. So the philosophy starts with the words I believe or we believe. I believe stocks with these characteristics are going to beat the market. And then you've got to put something down. Now, if you don't have a philosophy statement like that, then go out and find somebody else's that seems reasonable and just copy theirs. If it sounds good to you, says, wow, that sounds kind of good. Well, where might your philosophy be? Well, you saw mine. I want firms with good fundamentals. I want firms that are low risk. And I want firms that are trading cheap. Not necessarily cheap, but cheap versus their fundamentals and risk. You might look at technicals. So I've seen some firms there's one firm, GMO in particular, you can go to their website. GMO likes quality and momentum. They want firms that are high quality and display very simple momentum. Momentum is just moving average. Is the stock trending up or is it trending down? Stocks that are trending up tend to keep trending up. I've seen some investors that are thematic investors, top-down type of investors. So their theme is, hey, we think Asia's where growth is going to be in the next 50 years. We want firms that are exposed to Chinese and Singapore and South Korea and India. Companies are exposed to those countries' customers. So you look for firms that not necessarily have to be in China or in South Korea, but firms that do business over there. They can be U.S. companies that do a lot of business in China and India. That might be your theme. Your theme might be baby boomers are all retiring. They're going to shift how they spend money. I'm going to find firms, maybe healthcare firms or senior living firms or whatever. Firms that are going to do well because the baby boomers are going to start spending out their portfolio and buying certain kind of things. You might want to try to backtest your philosophy, but that is extremely difficult to do. And one reason it's difficult to do, when you backtest, you don't have what the market really looked like when you backtest. So you want to see, hey, this is my philosophy. What if I took the model I just showed you and I ran it, say, 20 years ago and see how it would have done the last 20 years? Well, the problem with that is A lot of firms in that model didn't exist 20 years ago, and there was a lot of companies that existed 20 years ago, like a Blockbuster, that don't exist today. So if I go back and run the model, my model might say, "Wow, you did well," but it might say I'm doing well because I don't have stocks that went out of business. It's not part of my universe. Whereas if I had all those stocks, including the ones that went out of business, there's a good chance my model might have picked some of those firms that went insolvent. My model might have loved Blockbuster. But because Blockbuster doesn't exist anymore, I go back 20 years, and that's called survivorship bias. It tends to, usually when you go back and backtest, there are certain forces that tend to make your model look a lot better than it really is. So the best backtesting that you can do is to build your model today and start running your model today. If you have some desire to start your own investment firm or your own hedge fund, get started. Get your numbers out there so you have a track record. You need a track record to show people. If all you have is say, hey, my model would have done really well in the 90s, you don't really know that because your model is using data that's influenced by the 90s if you go back that far. But it's also got survivorship bias. So there's some problems with using backtesting. But have a philosophy, a statement that starts with, I believe stocks with these characteristics, define what those characteristics are. So I just mentioned one, GARP. So you can definitely do GARP. GARP is growth at a reasonable price. So what you're looking for growth. Firms that are growing their earnings and revenues, and you're looking at valuation. So you can look up GARP, you'll find it on the internet, and you could reword it in your own words. And so in an interview, they ask you for some investment ideas. You could bring that right forward. You can say, yeah, I'm a GARP investor, I like growth at a reasonable price. Especially in this environment, I think growth is the place we need to be because entire industries are going out of business. So I need firms that are where the action is. These old economy firms that are going out of business or could go out of business, like a Valero if electronic vehicles come around. That could be your philosophy. I'm not saying that's the right philosophy, but it could be. It sounds good, and in an interview, you don't need a philosophy that your interviewer agrees with. What they're looking for is logic, that you can explain it in logical, clear ways of what you believe. And they're not really believing that this is what you're going to go with the rest of your life. They know you're coming right out of college. You're still discovering what you think is important, and you're going to do more. You'll make mistakes, and you'll learn from your mistakes. So just have something. Once you have your philosophy, then you got to have a process. And I just showed you the process. You pull in all of these stocks, you run them through a model that finds the stocks that meet your philosophy. So you might start with the Russell 3000 stock index and you screen down to 150 stocks maybe, or maybe you screen down to 10 stocks. But whatever, you have a process to get down to a certain number of stocks. If this is your entire portfolio, you probably want to screen down to say 50 to 100 stocks at a minimum, so you can have good diversification. So let's say you've done that. And I just showed you that with the spreadsheet. Have we screened down to ours was a smaller list of say 10 because we're buying stocks just for one sector. We weren't buying the entire portfolio. We're just focusing on one sector. But let's say you get down to 10 stocks. Now you got to get the portfolio construction, and that's that. Okay, we want to buy these 10 stocks, but how much do we put in each stock? We could go equal weighting. Equal weighting is a pretty popular strategy, and it tends to do well. It tends to do well because equal weighting tends to make you more of a value investor than a growth investor. When you do equal weighting, remember growth stocks are more expensive than value stocks. When you're equal weighting, you're tending to underweight growth stocks and overweight value stocks. So there's a reason why equal weighting has done so well historically. You could do fundamental rate weighting, which means allocate to the stocks based on their revenue or on their net income or something. Robert Arnott is a good name you could Google on fundamental weighting. You might have heard it as smart beta. Smart beta is a good term to look up. Not everybody agrees with Robert Arnott. I'm a huge fan of Robert Arnott. Very impressive, smart man. I love hearing him at conferences because he's just an exceptional speaker. And he writes some really, really good articles. So read what he has to write, but then there's people who criticize the fundamental weighting. They just say fundamental weighting is nothing more than value investing. When you do fundamental weighting, you're going to end up with a bunch of value stocks, and you'll be avoiding growth stocks. That's fine. That's, that does work well as long as you acknowledge that you have that bias. You can do market weight. Well, with market weight, you're going to end up with more growth stocks because the stocks that have the highest weight are the most expensive stocks, so you'll end up with a bunch of apples. And so if you weight it based on their market cap, you'll end up with more growthy. You can have constraints that say, hey, if Apple is 5% of the market, I want to have at least 4.75% in Apple, but no more than 5.25% in Apple. That's called enhanced indexing. We did that for a few years at UTSA. It makes some sense to me. I actually did a conference presentation on that, enhanced indexing. One of our portfolio enhanced indexing managers asked me to do a presentation at a conference. Even got a good laugh at the beginning of it. Just if you do the math on enhanced indexing, it implies you could find a perfect portfolio with no risk. The whole crowd knew I was being facetious, but the implied math implies something that we all know is not possible. But it's an interesting approach. There's another thing you could certainly look up. Enhanced indexing. What does that mean? So again, there's a lot of terms you can Google. In fact, on the philosophy, you could just Google popular investment philosophies and just see what comes up. Go to major investment firms like Fidelity, T. Rowe Price, and go to their websites and see if they have presentations on their investment philosophy. Or go to YouTube and look for those firms and see if the firms are making presentations. Their portfolio managers are making presentations, and see what their philosophy is. You might have a model that ranks stocks, so you score the stocks. And you say, okay, this stock was scored 1, this stock was scored 7, so we'll put more weight in the one that was scored number 1 versus one number 7. Some firms actually have optimization models where they bring in expected return, expected risk, or maybe expected beta. They have constraints on trading costs because they don't want to spend 0.2% on a stock that's going to add 0.1% to the return. We're not going to do an efficient frontier in this class. We don't have time. I do this in my risk management class. So if you want to learn how to do this, definitely email me, and I'll show you how you can do this over the summer break. So that's construction. Very, very important. Once you've figured out how you're going to construct your portfolio, then you have risk management. And that really comes down to your sales discipline. So you bought all these stocks, and let's say one of them jumps 50% and another one falls 30%. What do? Do you cut back on the one that grew 50%? Do you get out of the one that fell 20%, or do you buy more of the one that fell 20%? So you need a sales discipline. Every firm I've interviewed over the last many years, portfolio managers, the second you bring up the word sales discipline, they all clear their throats and sit up real straight, and they give you, oh, we're very disciplined in how we sell stocks. Some of them were, and some of them weren't. You might say, if a stock we buy falls 10%, we're going to sell it. We obviously messed up. Or maybe you have a price target. Our price target for this stock is $100. We bought it for 80. It's now trading for $100. It hit our price target. We need to sell it. And I'm going to talk about with options an easy way you can sell the stock without actually selling it. And you can sell it and actually get an extra amount of income. We'll talk about the kind of covered calls type of approach. So the sales discipline is important because we know with both retail and institutional investors, both groups tend to hold onto their losers too long, and they sell their winners too quickly. Not all has to do with ego. We buy a stock and it falls 20%. We don't want to sell it with a loss of 20%. We want it to get back to where we bought it, and then we'll sell it. We don't want to lose money, because if we sell it at a loss, we've admitted we made a mistake. But boy, we love to sell our winners. We buy a stock and it's up 20%. We're like, oh man, this is great. Let's sell it so we can show that we won. So on the losers, we tend to say, hey, we weren't wrong. We were just early. Versus going back and saying, hey, did something change? I heard this one guy, he was teaching high school, and he did not have an investment background. And he said, yeah, I tell my students, you haven't lost anything until you sell it. And boy, I didn't want to tell them how much I disagree with them. But if you buy a stock for $100 and it's now trading at $60, you lost 40%. Or you just say, well, I haven't lost it until I sell the stock. The question isn't, did you lose or make money? You lost money. The market now thinks the stock you bought for $100, they now think it's worth $60. So the question you need to ask is not, will it get back to $100? That's not important. The important question is, what is the stock worth now? If you bought a stock for $100 and it's trading for $60, and you think it's worth $40, you need to sell it. If you have a stock you think is worth $40 that you can sell for $60, you need to sell it. However, if you bought it for $100 and it's now trading for $60, but you think it's worth $80, then hold on to it and wait for it to get to $80, but then sell it at $80. Even though it's still a 20% loss, if you think it's worth $80 now, sell it when it hits $80. That $100, other than tax reasons, means nothing. It's completely unimportant. Your only decision is, what is the stock trading for today, and what is it worth today? And so if you're going to give them a good sales discipline answer, you want to make sure it's strong in that term. You want to not relate to when you bought the stock, but everybody knows that the original purchase price is a big part of your ego and all of our egos and how we trade stocks, and it makes us make really, really bad decisions. What I would really recommend is that you get some experience doing this by setting up a paper portfolio at a firm like thinkorswim.com. Test your ideas. The Investment Society has a investment market challenge where you can participate and see how you do, and they have winners and losers, and it's such short term. I don't think, wow, the person in first place, wow, they're a really good investor, or the person in last place, they're really, really bad. There's so much noise. It doesn't matter. Just get out there and start investing money, even if it's fake money, just so you get some experience. All right, so let's get into one of my favorite topics now. Let's talk about derivatives. Up to page 48 of the notes, this is the last topic. We could go absolutely wild on this. One of our former students, Eric Moss, really strong UTSA student. He used to teach our options classes for the Investment Society. He was actually a pre-med student, and as a pre-med student he started attending the Investment Society, and he just decided, and finance is where I want to go, and he also decided that options is what he wanted to do, and he's got a really great job in Chicago as an options trader. He spoke to UTSA students a few weeks ago. I don't know if any of y'all got to hear that. Really, really interesting. Great guy. Can't wait to get to Chicago and have an hour-long lunch or longer with him and just see what he's doing. Just really incredible knowledge that he's getting in a very, very short time. So he does options. Options is a derivative. So we do have some UTSA alums, and he was more than eager to help a UTSA student get into the industry, give them some advice, help them with how to apply. I mean, he was quite aggressive in how he pursued his career. He knew exactly what he wanted. Not a lot of undergraduate finance students know, hey, I want to do options the rest of my life, but he knew, and he jumped into that industry, and he's now getting just some incredible experience. So let's talk about derivatives. Why is it called derivative? Well, a derivative is a security. By security, that means it's traded on an exchange, although there are some derivatives that are not securities. We'll talk about them. But it's a security or an asset that derives its value from something else. So it's a derivative or something else. It could be from another security. It can be from a benchmark or an index. There's all types of these things, and it's amazing how Wall Street and financial engineering, how they've really created some incredible securities. It's a great book I read. I do recommend it. Just a very interesting book. It's a gentleman who worked in this market, and his job was actually developing new products for the firms, the exchanges that sell these products. And his question is, when can we create a new derivative? And the book is really fascinating how they went through that. They had some derivatives they thought would be great products, would have a great market, and just did not work at all. And so interesting book, really interesting book. So the nice thing about derivatives that makes it really simple is there's only two types of derivatives. The two types of derivatives are options and futures. And they have other terms besides that, but options and futures. So they're both get their value from something else, that's something else we call the underlying. So you can have an option on some underlying security or benchmark or index. You can have a futures on some underlying stock or benchmark or index. So what distinguishes between options and futures? Well, options give you the right to do something. When you buy an option, you have the right to do something. You don't have to do it. You can decide to do nothing and just let the option expire worthless, but you have the right to do something if you want to. Futures create an obligation. You must do something. So that's the difference. And the word option pretty much defines what it is. It gives you the right, the option to do something. Options can be options, obviously. Can also be swaptions. We don't talk swaptions in this class. I do talk swaps in my risk management class. They're probably the largest derivative out there, maybe the most important derivative out there. I use swaps at USA. I never got to do a swaption. Boy, I really wanted to do a swaption. And one of our alums was at USA after I had already retired. And his job, he was going to execute swaptions. And I told him, man, give me a call when you do it. I want to see how you go through that process. And then one of my former bosses heard about it, and he didn't like it because his department wasn't doing it. There was a whole political thing, and the whole thing got shut down. I was so disappointed. But what is a swaption? A swaption is an option to enter a swap. So you can see how finance has gotten really, really quite complex and advanced. When you buy insurance, insurance is an option. Your auto insurance is an option. You have the option to sell your car to the insurance company for its cash value. So if you crash your car, you can execute your option to sell your car at that price. We already talked earlier about your right to prepay your mortgage. That wasn't right, that was an option. You didn't have to do it. You weren't forced to prepay your mortgage. You had that option to do it. And you have the option to do it at some future stated price. Sometime in the future is defined in the option itself. You know, it might be 1 year or 5 years. When I did swaps, they were 5-year contracts. When I did options, they were usually 2 to 3 month options. But some right to some period of time, and you have some stated price. We'll talk about that. That's called the strike price. When you do futures, futures include swaps and forwards. Swaps and forwards are not securities. They're assets. They're not traded on public markets. Futures are on public markets. Options are on public markets. But swaps, swaptions, insurance, those are not publicly traded securities. Forwards are not publicly traded securities. Now, when I took the CFA exam, we had one book, the entire book. It was probably, 60, 70 pages. I can't remember. I devoured that book. I did all the math problems in it. I could not replicate it today. It's just been too many years. But that entire book had one purpose, and that was to prove that mathematically, futures and swaps are the same security. So, that whole book did nothing but that, and boy, I loved it. It was really, really good. I don't like futures. I don't like dealing with futures. I just find them less flexible and harder for me to really grasp in my mind. I love swaps. I just think they work a lot better, and banks tend to use swaps a whole lot more than they use futures. So let's get a little terminology. I've already given you a little bit of this already. But notional amount value applies to both options and futures. And the swaps and the forwards. The notional value is that tells you what your exposure to something is in dollar amounts. So it's a little hard to really visualize, but it tells you what your percentage return is going to look like, or your dollar return is going to look like. So if you have $1 million exposure to S&P 500 futures, that means if the S&P 500 moves 10%, you're going to have a $100,000 gain or loss. So if the S&P rises 10% and you're long, that means you're buying the futures. If the S&P rises 10%, you'll make $100,000. So your notional amount is $1 million. Now when we talk notional amount, the numbers are reported, but they're pretty scary numbers. Here's cryptocurrency, military spending, so you get some idea. Here's the Fed's balance sheet. That's the value of all the billionaires. Here's gold, including gold reserves. Who knows how they got that number. If you look at the stock market, here's the stock market. This is the Fortune 500, and then all stock markets. The money supply, debt, total debt. There's much more debt out there than there is stocks. Real estate, there's more real estate out there than stocks, and probably even more than debt. In global wealth, here's all the economies. And then we get to derivatives. So derivatives, here's the market value derivatives. That doesn't look all that large. But here's the notional amount. And this is the scary part. Look at that number. Notional value, low end estimate, we don't really know, but 559 trillion. The high end estimate is whatever a quadrillion is, 1,000 trillions. Now, that looks like a scary number. It dwarfs everything else. You know, you look at all the global wealth, and it's $361 trillion, and yet the low end on the notional amount of derivatives is almost twice that number, and the high end is 3 times that number. So how can this number be so large? And it is somewhat overstated. The media loves to report notional amounts because they're so massive. They're such huge numbers, but it's not really the number you want to focus in on to really understand the risk or the exposure. And the reason it's not is there's a lot of double counting. So if I buy a 1 million S&P 500 futures, someone else is selling it on the other side. Those two will offset each other. It might be two different people completely unrelated. One's going long the S&P by a million, someone's going short. On the notional amount, they're going to add those two together and you've got $2 million, but they offset each other. It's also true with bond derivatives. You might have one person has $1 million, another person has $1 million, but if the duration of one is 3 years and the duration of another is 30 years, the notional that's 30-year duration is 10 times more volatile than the one with 3 years. So you really can't use notional to express risk. The notional really only makes sense for your particular transaction. If you buy $1 million of S&P 500 futures, then you're exposed to the S&P as if you had bought $1 million of the S&P. You didn't actually buy $1 million, but your gains and losses are going to look as if you had bought $1 million. So it's really interesting when you enter this future, your starting market value is 0. You enter a futures and there's nothing on your balance sheet. But if the S&P rises 10%, suddenly that future that you bought for 0 is now worth $100,000. And I saw that. There was the swaps I entered at UTSA. They were worth 0. We bought them at 0. There was no investment. There was nothing for the accountants to put on the books. But a few years later, those swaps were worth over $400 million. So something that I bought for 0 is now worth $400 and something million. That's something the accountants are going to have to do something with that. Notional amount's important because it gives you a sense for that particular option or future. It tells you what your exposure is, but the cumulative of all the notional amounts is just an exaggerated number because it double and triple counts things. So that's the notional amount. Pretty tough term to get accustomed to. We won't really need it that much in this class. It'd be pretty obvious what we're doing. You'll see it when we do options. What is the underlying? It can be an asset, a security, an index, a price. It can even be inflation. It can be weather. There are weather derivatives. Wall Street has gotten really fancy on these kind of things. So it can be a specific stock like Apple. It can be an exchange traded fund, which is really interesting to me. It can be an index like the S&P 500 index. It can be obviously a commodity. It can be an interest rate, inflation, a currency. Currencies are a huge part of the swap market. Maybe I don't think they're as large as interest rates. I'm not sure. It's hard for me to remember which is larger between currency swaps and interest rate swaps. But yeah, weather, catastrophes, there's all kinds of things people are doing to create a derivative where your value is based on some other number, some other index. And it's all in the contract, so you know exactly what you'll get if the price goes up or goes down. And you can run models and all kinds of things. In fact, if you're a finance major, I would strongly recommend that you go onto the Bloomberg machines next chance you get. Bloomberg has really good models for options and for swaps and for futures. You can actually put a fictitious trade in and run scenarios. What happens if this happens? What happens if this happens? There are a lot of great resources. I won't go into all of these, but boy, there's a lot of resources. Khan Academy does a good job. CBOE, if you go to their sites, they have videos and they have documents. A lot of my students recommend this book on Amazon.com called Options as a Strategic Asset. I haven't read the book, so I can't recommend it. This book, Trading on Corporate Earnings News, I do recommend that book. It's not a very long book, and it's very well written to be understandable. The Options Guide is a great place to go. We'll look at some of these sites. And there are podcasts on options that you can listen to. So what I recommend on the podcast side is find 5 or 6 podcasts, maybe find 7, and listen to one a day and let it be a variety of things. I mean, unless you're absolutely sure options is what you want to do, then yeah, just listen to options podcasts all the time. But find different ones, and my book recommended book reading list has some of those podcasts, not these particular ones, but has those podcasts. So go out and expose yourself to these different experts in the field of finance. And they'll drill down. Finance gets really, really specialized, and they'll drill down, and you'll hear terms you never heard before. Go look them up, Google them, Wikipedia, whatever you got to do. If you find a podcast and you listen to it in the first 20 minutes, you don't have a clue what they're talking about, then get off that podcast and go find another one. There's one I just added recently to my book reading list that I really like. It's on investment allocation, very much what we're talking about in this class. So that would be a perfect podcast to add right after this class, because you're going to hear a lot of terms that we talked about in this class. But just get exposed to different concepts, different ideas, and then you might hear something and say, wow, that really intrigues me. That's really kind of like Eric did when he saw options for the first time. He said, I gotta do this. This has got to be my career. Then yeah, let these podcasts, you hear something really piques your interest, see if there's a job there. Listen to the podcasts and find out who the speaker is, and go find out what firm he or she works at and apply for a job at that firm. So there's a lot of ways you can expand your knowledge on your own time. So if you're at the gym, let's say you're at the gym 4 hours a week, then make sure at least 2 of those hours you're listening to podcasts. Maybe not all 4 hours, but all right. So we'll start with futures. We'll spend a lot more time with options. Our futures discussion is going to be very high level. I'd much rather talk about swaps anyway, but we can't talk about swaps. But swaps and futures really are the same thing. They look very different. They seem very, very different, but the end result is the exact same mathematical type of security. So a future obligates you to buy an asset in the future. If you're long on that asset, it obligates you to buy the asset in the future, so you're bullish on that asset. Or it obligates you to sell. So if you buy the futures, you go long the future, that means you're expecting the price of what the underlying is, you're expecting that price to rise. If you go short a future, then you're expecting the price of that thing to fall. So if you go long on oil futures, you're expecting oil prices to go up. If you go short oil futures, you're expecting prices to go down. So here's FinViz. I like finviz.com. If you go to the FinViz and then click on futures, they'll show you where all the futures are. Obviously on all the stock markets around the world. There's even futures on the VIX, which is the volatility index. We'll talk about the VIX here when we talk about options. You obviously going to have all the commodities, oil prices, gasoline, heating oil, natural gas, ethanol. You're going to have agriculture products, cocoa, cotton, orange juice, coffee, lumber, sugar. You have the metals, gold, silver, platinum, copper, palladium. You have cattle, hogs, cows. You have other agriculture, soybeans, corn, wheat, rice, oats, canola. Then you have your currencies, and then you have your bonds. Now, one thing to realize on bonds, some people get really confused. If you go long on the 30-year Treasury bond, you're betting on interest rates falling. So I've heard people say, hey, I want to buy the 30-year futures because I think interest rates are rising. That's not what you want to do. When you buy a futures on the bond market, you're betting on the price of the bond. Remember, bond prices go up when interest rates fall. So if you're long 30-year bond futures, you're betting on interest rates falling. So just be real careful on that. That's why I say do a paper portfolio first. You can see what's going on today. For some reason, lumber prices are up a bunch today. I don't know why that is. And the VIX is down a bunch today. That just means the market didn't move much today, so the volatility index came down. It's still hovering around 8. Well, actually 18, 19 is back to its normal level. It jumped up a lot last year. So you look at the VIX the last few years, you can definitely see COVID and how much the VIX shot up. So the VIX is the volatility index. So when markets are in turmoil, the VIX shoots up. You can see the VIX got up into the 80s last year. If you go even longer term, you can see the 2008 crisis. You can see the VIX again got up close to 80. It shot up real quick during COVID. It just really shot up because we were so uncertain there. But you can see, and then you see the Tokyo earthquake. No, I can't remember what happened here, but you see it volatile around. But over time, where we are right now, the 19, that's a pretty normal number. That's right in the middle. 17, 18, 19 is pretty normal. When it gets down close to 10, that's when I start doing some trades to try to take advantage of it being so low. But those are your futures. You can do, if you set up a paper portfolio, you could actually do options and futures in these markets. So what we'll do next class is we'll finish up options, and then we'll quickly finish up futures. We'll finish up futures, and then we'll very quickly get into options, and we'll spend most of the last 2 classes looking at options, and you'll have exam questions on options. So we'll get into options pretty quickly. I will probably not spend much more than 10 or 15 minutes on futures next class. So we have a good lengthy amount of time on options, and it might mean my class length, the length of the class has to go a little bit long to make sure we can cover everything on options. I won't go over 75 minutes, but I might go over my typical hour session.